Good morning, everyone, and welcome to today's Wealth Exchange webinar, Sharing the Pie, the Art of Building a Winning Culture. I want to quickly remind you that today's webinar is intended to be interactive, so please do submit questions through the Q&A, and we will have a Q&A session at the end of today's event. My name is Vanessa Flockton, Senior Vice President, Advisory Services here at Nicola Wealth. And today we're going to talk about how a counterintuitive approach to building a business can actually develop culture and ensure incredible growth and success. At Nicola Wealth, the concept of sharing success or sharing the pie, both within and outside our organization, has become one of our firm's core values. Here's what a few of my colleagues have to say about sharing the pie.
At Nicola Wealth, we believe that sharing the pie goes beyond the walls of our organization. Fostering a culture of giving back is very deep rooted in our beliefs. As a firm, we allocate a portion of our profits every year towards charities that are very near and dear to the hearts of our clients and our staff. This is done through the Nicola Wealth Gives Back or the Nicola Wealth Private Giving Foundation. We are passionate about supporting various causes and providing a handout for our communities, regardless of the circumstances. We're very grateful to be part of this journey, and we look forward to making an impact for many years to come.
One of the first things that's actually the most important is that Share the Pie has actually been an underlying philosophy of the organization since its inception for 25 years. It's not a new thing. It's something that has actually been part of the DNA since it started. We all share in the success. We all share in the work that each of us does together. We get the underlying benefit of sharing in the success of the firm, the growth of the firm, whether it's through shares, options, and profit share. But beyond that, we also have a shared responsibility to the success, what is called effectively skin in the game. We all have skin in the game. We have responsibility to the organization, we have responsibility to each other. And together, I think we are stronger as a whole than we are as the sum of our parts. And I think that has actually been one of the secrets to success of this firm.
So as noted by my colleagues, from our perspective, sharing the pie is so much more than a profit sharing plan. It's really the foundation of our culture and a critical component of our long-term plan to build a successful and enduring company. In my time at Nicola Wealth, I've witnessed this firsthand and seen the impact it's had on our organization, our people, and our community. It's my pleasure to introduce the man behind the vision, who has grown Nicola Wealth from a 7-person company with 80 million in assets under management to a 300 plus million company or 300 plus person company spanning the country and responsible for managing 10 billion in assets under management for our clients. Please join me in introducing Nicola Wealth Chairman and CEO, John Nicola.
Hi. I had to
Hi,
make
John.
sure I hit all the right buttons. Yeah, I hope I got this right, okay? And hello, everybody. I know there's some other people out there, and I can't see any of you, but anyway, hello, and thanks for dropping in on this. This is really enjoyable. So go, Vanessa, I know. So should we get started?
So John, I mean, I've shared with everyone, I've provided them with an overview of what Share the Pie means, and we've seen a few clips from our colleagues. So many people will think that sharing the pie means that they're giving something up. Can you explain why that's actually not the case and that sharing the pie can actually help you build a stronger and more profitable company?
Yeah, I mean, I think I do appreciate that, at first blush, obviously, if a corporation, ends the year, makes a certain amount of money and then takes a part of the profit that it earns and then disperses it amongst all of its staff, by definition, it is an expense. It's probably tax deductible, and the profits for the company would be less than they were going to be had that profit sharing not been paid. So if you looked at it from a purely accounting perspective, it is obvious that basically it looks like a zero-sum game. But let's say we took a look at it from a slightly different perspective. Let's say the same company made a decision to invest in some new equipment or a new strategy or a new marketing approach, which obviously also costs money. And let's say that the amount of money it costs is $1 million. But let's say as a result of spending the $1 million, they generated $10 million in revenue and $2 million more in profit. Well, now all of a sudden, what was now formerly an expense now becomes an investment, has a return, and doesn't detract from your bottom line, it adds to your bottom line. So the purposes of our discussion today is to say, okay, well, is there any evidence to support that? We can certainly suggest that from our perspective, there is evidence. In fact, let me just, if it's okay to share a screen, I'm going to show you, a few years ago, I got involved with a presentation with, there we go. Is this working? Can we see that screen?
Yeah, it's working, John.
Great, okay. So, here we go. So in this screen here, this is it came from the Canadian Federation of Independent Business, and there's lots of data on here. Let me just focus on a couple of important numbers. So at that time, this is about 4 years ago when we were doing this presentation, 72% of owners intend to exit their business, and they've got $1.5 trillion of equity. Now we're talking about small, medium-sized private businesses, not any public businesses here. And about 25% of the owners of businesses plan to transition it within the family. And when it came down to it, almost nobody had a succession plan. 8% had a formally written plan. 51% have no succession plan whatsoever. And the issues, barriers were, you know, they didn't know how to value the business. They were too much dependence on the owner. They didn't really know how to, they couldn't provide financing to any successor, and so on and so on and so forth. And when their advisors would come to them, they would say, okay, well, you could sell your business by being an acquisition of another company. You could get a friendly buyout, maybe, you know, a friendly competitor, sell to your employees, sell in the open market, all of these things. And the question it occurred to me is that everybody answering these questions is waiting until they're just about ready to leave to say, well, what do I do now? So why wait until you're actually ready to leave? Does retaining some equity in your business make sense? And how would these questions look like? How would you answer these questions if you had taken a share the pie approach right from the beginning? So my view essentially is that people can use the concept of share the pie, not just to actually be fair both to their staff and to their partners and to their community. This is a great way to develop an alternative approach to deciding how you're going to transition out of your own company. So for business owners, this is a very practical way of developing an exit strategy. Let's just go back and we can stop sharing.
Terrific.
Okay.
So John,
Yeah.
I mean, so obviously the share the pie can be used for succession planning, and I know we're going to talk about that a bit later today. But maybe you could also just talk about how sharing the pie with, you know, staff and community helped Nicola Wealth kind of navigate the challenges that we faced over the course of the last year and a half.
Well, obviously, I mean, most businesses went through some challenges with COVID. Some are obviously still are, depending on the business that you're in. We weathered that storm really well. It's not like there weren't some impacts on what we did. And just let me see if I can give you some examples of this. I'll just go back to this slide since here we go. Every year we do a business plan, and we did one for 2020, like every one of the 26 years before that. And in this case, we used a theme of a book written by Simon Sinek called The Infinite Game. Great book. And we had our plans for 2020 well put out. This business plan came out in January of last year. And then, of course, we know what happened after that. One of the themes that he talks about is this concept of just cause. And I think this was something that really resonated with us. In fact, all of these concepts that he's got, trusting teams, worthy rival, existential, flexibility, and courage to lead, are all things that mattered to what we did last year. So the just cause includes things like it's for something as opposed to being against something. It's affirmative and positive in nature. It's inclusive. It's open to all of the people who want to make a contribution. It's service oriented. for the primary benefit of others. It's resilient. It's able to endure political, technological, and cultural changes over time and pandemics as well. Idealistic, it's thinking big and bold while realizing that there's no end game or finish. It's just playing the game better. So really, it's not so much about goals that have actually finite outcomes. It's about making sure that we have a right structure and process in place. So when we take a look at all of these other things, our industry, by the way, is notorious for developing individual advisors that operate in silos. Our focus has been on collaboration, and again, sharing the pie allows collaboration to occur in a much more effective way. We have some great competition. We look at that competition and try to figure out how to increase our own standards as a result of that. When challenges come, as was obviously the case last year, we have to create and innovate. One of the things that occurred last year that was extraordinary is that we brought in as many new clients, in fact, somewhat more new clients in 2020 than we did in 2019, and basically met none of them in person. I mean, something that we had never attempted to try before and had no idea initially how exactly to do it, but we accomplished it. And then the courage to lead, basically taking lessons from other great leaders, people like Sinek and Collins and people like that. This is a great quote from Mike Tyson: "Everyone has a plan until they get punched in the mouth," which is what exactly happened last year during COVID-19. So by March of last year, the stock market was off 35%. All asset classes were falling. There were zero, interest rates were zero, unemployment and deficits went through the roof, and we all worked remotely. Now, by the end of the year, how's it going? Well, our revenue, it was down about 10%, our profit about 23%, but it was still a profitable year. We onboarded more clients in 2019, as I mentioned. Our assets under management were up 7.6 billion by the end of the year, and we added 50 new staff virtually, which is almost, maybe that's even tougher than adding on new clients. And we weren't sure what was going to happen, even at the end of last year. It could be, given what was going on with case rates, it could have lasted another year easily. It would appear now to be not so much the case. So we were looking at these issues last year: the brutal facts, the next generation planning, focus on people's dreams. That's what our objectives are for clients. And pay it forward, which is also part of sharing the pie, which is part of our culture. So what we looked at is all of these factors, and we put them together and said, okay, look, if we get this right, as Tim had said, the whole will be greater than the sum of these parts. So as of this month, 6 months later, we have actually increased new clients and revenue 43% over any other year that we've been in business. We just passed, as you mentioned, 10 billion of AUM. We have incredible high levels of productivity engagement, even though most of our people are still not working at the office. They are working on a remote basis. So one way to define this concept of sharing the pie. So we do it two ways internally. Now we're just talking from a staff perspective. We give profit sharing, and it looks this way. All staff are entitled to it. We started using profit sharing before we actually started the company, when I was working at another company. It's equal to 10% of profits after the shareholders get a reasonable return on their capital. So it works out to about 8.5% of net operating income. We wanted to choose a number that would have a material impact on the annual income of the recipient. So the idea that you provide a bonus that would be, I don't know, $2,000 to somebody making $85,000 a year is not material. It has to be material. And when I say material, I'm saying a minimum of 10% of a person's annual income, and ideally 20. On the equity side, we've been doing shares since the beginning of the company, and we've been using options for the last decade, and I'll explain how the options work in a minute. We allocated those have been allocated to people that we believe can build the business, about 20% of our total staff. It's merit-based. The options are vested immediately and they last 10 years, so people have a long time to exercise them. But when they do exercise them, they have to be funded with cash when exercised. So let's take a look at profit sharing, expense or investment. Remember when I started, as I was talking about the you know, at the end of the day, you're writing a check to your staff and it's deductible, so it has to be an expense. And that is appears to be the case. And you could even make as I said, the accounting argument that it is the case. But let's take a look at what happened in 2005. Our profit sharing as a percent of wages that year was 8%. So let's say a little under the target I would have liked to have seen. And our expense ratio that year was 37%. Now, 5 years later, profit sharing now made up 15% of everybody's pre-tax income, staff income. But the expense ratio didn't go up. It actually shrank a little bit to 35%. 10 years later, this is now last year, which was a challenging year for lots of firms. Our profit sharing now was 25% of pre-tax income for staff. And our expense ratio was now down to 30%. And year to date, because we're having an extraordinarily good year, profit sharing is 40% of wages on a year-to-date basis, and the expense ratio was dropped even further to 26%. So if you think about it, if profit sharing is an expense, your expense ratio should rise if you're making it a bigger number and a bigger percentage of wages every single year. But that's not the case. The opposite is the case. So therefore, from our perspective, profit sharing is absolutely an investment. In this case, it's an investment in people. And it's really saying to them, okay, you're working here, and without you actually having to own a share or an option, you are a partner in the firm. And you know, part of your well-being, financial well-being, will be tied to the success of the firm.
So John, I was just going to say that's actually a good opportunity to maybe segue.
Yeah, sure.
Unless you actually want to go into the history, I was going to say, if we're talking about the level of compensation that profit sharing pays to our employees relative to their overall salary, maybe talk a little bit about how that helps us attract top talent.
Well, I think, and there's two ways. So based on the interviews that we've done and with individuals, I think people are they're looking for firms where they have the opportunity to make a difference in the firm. And if they accomplish that, if they actually make that difference, then they get to, as they say, participate in the outcomes, the benefits that the firm generates. There's another thing, though, that's interesting, and Grace referenced it as well, that a lot, especially for younger and newer employees, what we do as a company in terms of the commitments we make to philanthropy and giving external to the firm are a major component for young staffers in particular. They want to look at being involved with a firm that has a specific purpose and objective. So from our perspective, when we think of share the pie, there's the sharing of the pie with the people that are within the company, the sharing of the pie with the people who are our clients, the sharing of the pie with the community at large. All of these are parts of what we mean by sharing the pie. It's not just simply a form of financial benefit to people who work in the firm.
And do you want to maybe talk a little bit about the sharing the pie with the community, and especially how we approach that through the COVID environment?
Yeah, but that was interesting because last year, we had sometimes you go through evolutions and epiphanies. So about 8 years ago, I don't know why I was asking this, because generally speaking, the people within the firm have been quite generous and donating money to various organizations and stuff like that. And I just popped into my head. I said, "Oh, just curious, like as a firm, how much money do we give away?" And I was thinking, it was a pretty healthy amount, and it was in 2013, I think, and it was apparently it was $10,000, and I thought that's ridiculously small amount of money for a firm of our size at the time. And I said, "Oh, maybe we should be more purposeful here." So basically, I asked the other shareholders, and I said, "Look, how would you feel if we committed a certain minimum percentage of our profits each year? Why don't we start, let's say, at a small amount, a commitment of 0.5% but agree to increase it from 0.5% to 1% to 1.5% to 2%, and eventually get to 3% of pre-tax income as a commitment." Okay, so, and everybody's, when they think of it that way, it wasn't a really tough decision. It meant that at worst, they would be getting 97% of the profits would be allocated to the shareholders. So there was strong support for that, and all of a sudden the 10,000 the next year became 100,000. And last year, during the COVID year, the commitment based on the prior year's earnings meant that we were going to commit to $1.2 million to be donated to a variety of organizations. We have a special charity committee that's staffed obviously with people internally that are volunteering to champion various organizations and make a case for supporting, ABC or XYZ charity. And most of the charities are community based, here and in Toronto in particular, where our firm's offices are, and in Kelowna. But there are some that are international as well. And we realized last year, because we heard a lot of the charities, their fundraisers were shut down, their revenues were drying up, especially in the first 6 months of the year. So we took most of our commitment for the year, and we basically funded it to our organizations that we support during that first 6 months. And I think it helped a lot of those organizations get comfort, because not only could they get the funds that they might have received from us in October, they were receiving it in April, but they could use that and leverage it with other potential donors to say that, that they had some of these, we had made a commitment to them and delivered it relatively early in the year. So I think what we do philanthropically is very important to all of the people in the company. And I think that's a very important part of what we mean when we're talking about sharing the pie as well.
Okay, terrific. So we actually have a question, which I think might go back to sort of our historical success with sharing the pie, and then moving into what other companies can do. So I'm just going to read this question to you. It says, your slide showing expense ratios going down while profit share as a percentage of employee income goes up is very compelling. Do you think that this would hold true for most companies that use a share the pie approach? Are there other tools one has to use in addition to profit sharing to make this program effective?
Okay, it's a great question. So let's just maybe deal with the first part of the question first. So of course, I don't run, I'm not running a factory. We are a professional services firm. So I don't want to suggest that, I know for a fact that profit sharing would automatically change the profile of a company, but my gut tells me that it would, that essentially people's response in terms of productivity and making sure they have the right people working next to them. Maybe I can give this story using this anecdote. When we first brought in profit sharing officially, so we started, now this is when we were 8 people back in 1994 when we started. Our office manager at the time, who's now our chief operating officer, Jamie Duncan. So I was talking with her and I said, look, what about this profit sharing? How do we distribute it to everybody? Is it just going to be an equal amount to everybody, or is it going to be based on wages, or do we need to maybe get performance reviews and decide who should get the largest share of profit sharing? And she said, well, why don't I go talk to the staff? And she came back a couple of days later and said, well, it's really simple. They don't want it to be based on performance, and they don't want it to be based on an equal amount. They want it to be based on wages. And so basically we decided to do that, and we kept that model. We've kept that model ever since. But I said to her, I said, why don't they want to at least have some basis of performance connected to profit sharing? I mean, what if they're working next to somebody who's completely lazy, doesn't show up properly for work, is sloppy, doesn't get their work done? And they said to her, we've thought about that, and we'll take care of that, because we're not going to let anybody work next to us who is that way, who doesn't fit into our culture, who's not committed to what we're doing. So you don't have to worry about whether or not everybody's putting the effort in. They're putting the effort in, and therefore we think this is the fairest way to distribute the profit. So in other words, it means then that the staff are, to a very large degree, they're self-regulating. And I can't help but think that that is a major productivity boost for any company.
Great. So we do have a number of business owners listening to the webinar today. And, and an ongoing issue, which you sort of raised earlier, is the concept of succession planning. Yeah. And how do you effectively plan for that and sort of motivate individuals to really care about the sort of long-term enduring outcome for a company?
Okay, so actually that's a good way to segue into this next slide. here. Let me see if I can get back to that. Okay, I think I can. I'll go and okay. So can you see that, Vanessa?
Not yet, no.
Not yet. There we go. Now?
Yes, thanks.
Okay. What we're looking at, this is a way of answering the question you just asked, Vanessa. What we're looking at here is the way that shares in the company have evolved since the beginning to now. And it actually, interestingly, also answers the succession question, I think, pretty well. So back in 1994, there was one shareholder, that was just me. And then a couple of years later, 2 other people bought in and they bought 10% of the shares of the company. And then our current president, David Sung, joined us and merged his company, Water Street, into ours. And along with the 4 other shareholders, they added up now. 7 shareholders now own 26% of the company by then. So we were not quite a decade old. And then as you can see, 2007, 11, 16, and 2011 is when we first started using options. 2016, we were now up to 25 shareholders. They own 36% of the company. Before COVID, we got to 7 billion of assets. We wanted to get to 15 billion within another 5 years after that, 2024. And 40 shareholders own 42% of the company. And then fast forward, not even 2 years, a little under 2 years time, we passed 10 billion of AUM, as we've mentioned. And that's 10 times where we were in 2009. We have 59 other shareholders that own 51% of the company. So here's the point. If people were asking me personally, well, what's my succession plan? These 59 people are my succession plan. At the end of the day, they have a very big stake in the company and they are very motivated to see where the company goes and how it gets there. And almost all of them, not all of them, but almost all of them, I would say 90% of them are younger than I am, and considerably younger in many cases. So my view essentially is that this becomes the transition plan. So we don't have any plans to try to have the company bought by anybody else. We don't want to go public. We don't have any other things except to say we want to continue, because we think we have the model that will go from, if you think of me describing as a founder myself as generation 1, generation 2 is already in place and ready to continue to run and operate the company very well. So while I have no personal intention of retiring, because I really enjoy the work I do, the reality is the framework that's necessary for CEO succession is completely in place. And the other thing I should mention this, and I will just see if we can get this one out. People talk about, you can see this in graphically now. I've gone from 100% to 49%, 59 other shareholders owning 51%. But here's the telling number. My 49% today is now worth 250 times what my 100% was worth 26 years ago. So if that was an investment, if we were managing this as an investment account, we would have had to have earned 24% a year return for 26 years in a row to get that result. I do not believe for a second that this would have been possible if I still owned 100% of the company. I don't think it would have been anything like this at all. So actually, as it turns out, even I've thought about it selfishly, this was the best way to build wealth and capital in the business, as opposed to trying to hold on to the entire pie.
So maybe, John, go ahead.
Yeah, no, and this is just a graph of the AUM growth that you mentioned from 80 million to 11, and that's been 20% a year growth. Again, speaking of things that I don't think would have been sustainable by me having 100% of the shares, that's another thing that wouldn't have happened, okay? And this is the share price. Now, this is only measured the last 10 years because that's how long we've been doing valuations, but this will give people a better idea of how we get to the issue of issuing shares and options and how dilutive they are, okay? So the share price is driven by our operating margin, like our EBITDA, the growth rate, which of course has been really good, the level versus one-time income, which in our case is very high, the weighted cost of capital in any particular environment, how big we are in relation to the marketplace, and external market transactions. So we get a valuation done formally every year, and that's how the share price is based and how the buy-sell works. And then we have issued options for the last decade. We're measuring a period of time for the last 7 years. Here are the options that were issued, okay, And these are the ones that have not been exercised, that the other ones have been exercised. So it works out that 1.5 million options were exercised in the last 7 years. So people talk about an exit strategy. And if you take a look at this, you can see that means that people have invested $25 million. Our own people have invested $25 million in capital to exercise those shares. They don't pay any tax when they exercise the options because there's private company shares. And when they do pay tax, it's taxed as a capital gain. So there's a big incentive to use shares and options as opposed to using bonuses. It's equal to 6 to 7% of outstanding shares. But it's only dilutive to existing shareholders if the growth of the company is less than the new options issued. So without getting into the math in a fancy way, if our growth was less than 6 to 7% a year, issuing options would be dilutive, but it's not less than 6 or 7%. It's much, much higher than that. So this issuing options is not something that dilutes the value of equity for the other shareholders. So does that, Vanessa, maybe help explain sort of how more mechanically how the numbers work in terms of what we are actually doing each year with the with shares and options?
Absolutely. I mean, there was one question early on, I think referencing the comments that Tim made in the videos about having skin in the game. And so obviously, you know, employees who are participating in profit share are going to see their incomes change year over year, subject to the profitability of the company. But then we also have people that have sort of a piece of the rock in terms of actually owning shares in the company for the long term. And so do you think there's a difference in terms of the objectives that the company is trying to achieve with those two modes of sharing the pie?
Yeah, without question. The point of when you're looking for somebody to be a shareholder in it's certainly a private company, and especially one where you're operating the business, you want the other shareholders to be committed to the long-term growth and development of the company. So even at the expense of, let's say, revenue or profits in any particular year, you don't want them to be thinking, okay, in that short-term annual performance basis, you're thinking, okay, I've gotten options. That's why they have a 10-year vesting schedule. I got 10 years before I have to exercise them. I own shares. When I own the shares, I'm going to keep the shares as long as I'm actively engaged in working here. And so in some cases, we have shareholders that have had their shares for more than 20 years and no particular intention or desire to sell them. And they'll maybe work another 10 years or 15 years and they can sell them at that point in time. So therefore, that's much different than profit sharing, which is to say, okay, we've had a good year. This year, we're giving you this amount of money to represent your contribution in the current environment, as opposed to what we're hoping to see over the next decade. So the two things, one's long-term, obviously, and one's immediate or short-term.
So I think, you know, there's for the business owners and on the call, they might wonder, what do they do next if they wanted to implement some form of profit sharing or share the pie concept within their own companies?
I probably would start with profit sharing because it is simple. It's not, there's virtually no actual cost to set it up mechanically. You just have to decide on a model. So our model was based on say, okay, there's a certain amount of capital in the firm, and if we don't make, let's say a return on that capital, and you can pick any number you want, but let's say you pick 10%. So if you've got 10 million of capital in your company and you make 10% on that, that's $1 million. And what we would say is, until we make $1 million a year, we don't really have a profit. We just have a normal return on the money that we have put into the company. So if the company made, let's say, $5 million, the first $1 million is not considered by us to be profit. The next $4 million is considered to be profit. And let's say we agreed to pay 10% of that, in this case, $400,000, to our staff. And then it would be allocated amongst all staff. And everybody would be eligible, maybe a waiting period of 3 months or 6 months in our case. What you hope for is that the number you picked is material. So what you want is to say, is that likely that $400,000 is at least 10% of everybody's income when they get their particular share of it. And then it's impactful enough for people to say, okay, we're paying attention. How the company does, it matters to us. Tell us the numbers. So we share the numbers with all of the staff. How are we doing? And the profit sharing is allocated by us on a quarterly basis so that we don't wait completely till the end of the year. And I don't, I know people have said, why don't people just take this stuff for granted? Once they've had it 1 year or 2 years or 3 years, they just assume it's automatically there. I don't get a sense of that. Our senior leadership team doesn't get a sense that that's indeed the case. They appreciate the fact that the profit sharing is at risk. For instance, last year, it was about 15% less than it was the year before because of, the challenges during the COVID year. And I think people understood that that would be the case. But the fact is it wasn't zero. So it meant that, a lot of good things were getting accomplished. So I would choose profit sharing first because it's not hard to actually implement. And then with respect to shares in the company, a lot of it depends on who you would want to see as part. Like I would probably, if we were starting from scratch today, I would probably start with a manageable group of people. Like we have 60 shareholders now. I would probably go back to looking at 5 to 10 key people within the company. And I would ask them not necessarily to buy new shares in the company, but I would probably say, we're going to start issuing you options in the company so that you now have some skin in the game. Some of those people would exercise the options immediately, and they would be allowed to. One of the things I didn't mention is that we pay dividends on the shares because I think shares should pay dividends. Some of the profit should be distributed every year. So the dividends on our shares historically have worked out to around 7% a year. So for most people, they can exercise options knowing that the income on the shares they're getting, as long as the company remains profitable, is enough to service any loans or debt that they might have taken out in order to exercise the options in the first place. So that provides some, it's not guaranteed, but it's worked out. We've been in business 27 years and we've never missed a dividend, and we've never decreased the dividends either. So there's some kind of track record there that people can hang their hat on at least a little bit. So I would do things. I would eventually get to where we are now, but it would probably, if I was starting from scratch, it might take 4 or 5 years to do that.
Right. Okay. So, I mean, my own experience, I've been with the company about 11 years and sort of watched it grow from a 60-person company to a 300+ person company. And, what I've experienced is that sort of that buy into the entrepreneurial culture and the firm sort of objectives and goals that I think that the participation in the success of the firm has created amongst our people. So can you maybe talk about how profit share influences culture and that desire to be able to build an entrepreneurial culture?
Yeah, I mean, at the end of it, in my mind, at least, and partially this is because, what do we actually do for a living? Well, basically, we're a wealth management firm focusing on, a very diversified asset allocation model, but also doing very advanced financial planning for our clients, who are typically they're either in a senior management position in business, they are self-employed professionals and business owners. In other words, essentially, they're to a large degree have an owner mentality when it comes to the business and the operations they're involved in. So from our perspective, I want as many people in the company to be thinking like an owner, taking the responsibility like an owner, thinking our clients are where we want to focus at the highest levels of service that we can provide. And then thinking from a broader perspective, that if they can build something that really, gets some extraordinary results, then they have this, I guess, what I would call pay it forward mentality within the community. In other words, if we've done well as a firm, which we have, and we're in a community where there are people that have strong needs, there are strong challenges, whether you're talking about the downtown east side, we're big supporters of Connect Place and Children's Hospitals. There's lots of places where the needs are extraordinary. And the fact that if we have the benefit of performing well financially, you want to have that mindset that says, okay, we need to give back to the community that's allowed us to do so well. in terms of running an operation in an enterprise. So culturally, people here very much support that. So they support each other in how they work in terms of saying, okay, we are building this as a group, as a team. And then when we get some collective results, we know where we think it should be shared. So that's a huge part of our culture, that people have that built in. And new people who join us, well, to a large degree, obviously they're being filtered to some degree on the basis that we believe that they have bought into that model and that culture.
Terrific. Well, and maybe you could talk a little bit about how we created the Nicola Wealth Private Giving Foundation to help our clients be able to share their pies as well.
Yeah, that was interesting. So it was just an idea that we came up with, and it was off. It never really got off the ground very much, but it's actually 25 years old now, so it's almost as old as a company. And it's a public foundation, and we just said, okay, if you want to donate money to a variety of organizations, one option you have is open a donor advised fund or account with us, and that'll act like a mini foundation for you. So you put in $100,000, you get a $100,000 deduction, and now you've got $100,000 in your donor advised fund, and you could now start making distributions. You could ask for money to go to the Salvation Army or Union Gospel Mission or whatever organizations you wanted to support, and we will take care of all the paperwork, and we'll make sure that you've got the appropriate recognition is given and all of that. So one of the things we made a commitment to do from the very beginning is we said we'll whatever the costs are to run the foundation, to create the foundation, to run the foundation, to do the administration, to do the filings that are necessary for compliance, we will pay for. So when you have your donor advised fund, there will be no additional costs. We'll just simply cover those costs to encourage you, the client, to be philanthropic. So as I said, it took a while to get some traction, but now we have about 330 donor advised accounts within PGF and almost 150 million of assets under management within PGF, and that makes it the fourth largest donor advised fund amongst Canadian financial services companies in the country. So from our perspective, it's achieving what we wanted it to achieve, which is a very significant increase in awareness for philanthropy amongst our clients. So we don't have any axe to grind about where the charitable dollar should go. As long as it's a registered charity, then we have no issues at all with that. We don't make recommendations about where people should donate money. We just make sure that they have this facility that they can use to make the kind of gifts that they would like to make, and to create a legacy as well, because this account can transcend the client. It can go from the client to the children of the client and so on and so forth. It doesn't have to be wound up as part of the estate.
Okay, terrific. So, I mean, John, thank you for sharing your story and explaining the share of the pie concept. I think we're getting close to making sure that we have some time for Q&A now.
Sure.
So
okay.
Why don't we, I'm sure our participants do have some questions. I think there's got a couple more here. So I'll move on to asking you some questions, and we'll go from there. We have another one here from Brian Wong. Now this I think might relate to your reference to Simon Sinek and the infinite game, and says, John, can you elaborate on how important the habit of reading has been to you over the course of your career? And what are one or two other habits that have been tremendously beneficial to you as a business owner?
Okay, so it's interesting about the reading one. I have to admit, when it comes to, let's say, formal education and going to school and taking classes and doing exams like that, I'm not really a great student. Not like I got bad marks. I got actually pretty decent marks, but it's just not something I enjoy. So most of what I've learned since I started working has come from being self-taught. And the only way to, in my opinion, to teach yourself is to either attend organizations or seminars put on by some very bright people, and or read a lot. So I tend to read many books. And so I'm a big fan of a lot of readers. And going back to my youth, the people that really got me started in terms of both philosophy and principles were writers like Scott Peck and Stephen Covey. And then I just kept track of the various generations of authors that have these great ideas about just first principles about the way one should consider living one's life. And then in addition, as it relates to business, what are the best business practices? What works? What is proven empirically? Jim Collins being maybe the perfect example of an author who has really studied and understands how to do that well. Peter Drucker before him. So many great writers with so many great ideas. So it's just really enjoyable for me. I just usually can't wait to get the next version of what they put together.
Okay, terrific. We have a great comment here from James Chan, who has said, I need to own Nicola shares given the 7% dividend. I need to consider a career change. So I think my response to that would be, we're always looking for great people. So
yeah, you never know. James, I might work out quite well.
Okay, and then we have another one here from Peter Mogan. Some companies make share ownership universally available to employees. Others reserve the right to senior strategic employees. What is Nicola Wealth's approach to who is entitled to buy shares? I note that 51 of 300 employees are shareholders.
Yeah, it's a great question from Peter. Up until now, we've absolutely made the decision about who can be an option holder and a shareholder. But I remember just maybe a year or 2 years ago, one of our staff people had just received, a very nice profit sharing check. Just said, look, what if I didn't want this check? And what if I'd rather have shares instead? Which is an interesting vote of confidence in the company. And I thought about it. I said, well, there's no particular reason they can't buy shares. And they couldn't use their profit sharing to buy shares. And in fact, from an income tax perspective, it would be actually quite easy for us to have people contribute their profit sharing to their RSPs where they're not actually paying tax on what they receive. And it is possible, especially with smaller shareholders, to allow their RSPs to buy shares in the companies in which they work. So we are getting some analysis completed to say how viable is that. And I would imagine in the future that we'll be able to say to people that work here, if you want to do that to the degree that you receive X dollars in profit sharing, if you would prefer to use that money to acquire shares in the company, fine. I can't see any logical reason why we would prevent that.
Terrific. Another one here from Justin Annis. Hi, John. Have you ever had to consider a scenario where a non-employee wanted to become a shareholder, such as a very large client investor? If a client wanted to give you X dollars, but wanted a piece of the business, would you ever consider it?
Yeah, so that has come up in the past. And we have obviously up until now said no. There is an interesting problem that kind of is the reverse of that. So pretty well all of our shareholders obviously have their money invested with the company, which also means that they're also clients, of course, and they're shareholders, and they're, in this case, most cases active. But then at some point they become inactive. They might decide to retire. And the question is, okay, do they have to sell their shares? We have the right to buy those shares back, but should we do that? Is that something we need to do and have to do? And so we've left it on a case-by-case basis. I mean, on paper, in theory, there's no particular reason that a shareholder actually has to be actively working in the company. And it's interesting when you look at it from what we do as a living, because we might recommend that you invest in our private equity pool or you invest in any of our public equity pools. And by definition, what we're doing is taking some of that capital and we're putting it into companies. And none of those companies do you have to work at. You don't have to punch a clock. You don't need to be a director, but you are entitled to the return on those company shares and any dividends that they would pay. That's how we invest money. So is it a problem if somebody said to us, can I just simply be an investor in the company, our company? So on paper, philosophically, I don't really have any problem with that. As a practical matter, though, we have a very significant balance sheet. We have a significant amount of capital. We have no particular need to bring in new capital for shares. And we have inside people who would like to exercise options, or in this case, also profit sharing. So we would make them the priority. And right now, basically, just based on them, we really wouldn't have any room for outside shareholders to come in. So essentially, if somebody did approach us like today we would politely say, thanks very much for the vote of confidence, but the answer would be no.
Okay, great, thank you. So one last question here. Can you share your thoughts on how to encourage clients to get active in dispersing funds from their private giving foundation accounts? So many donor advised funds have low disbursements, which defeats the charitable intent.
Yeah, you're absolutely right. I mean, it's in our situation, it's just the opposite. So just last year alone, and this would be arguably a tough year for, as I see, charities. Our disbursement percentage last year was 15% of the capital in 1 year. Our disbursement quota is 3.5%. We are many, many, many years ahead of our disbursement quota. We've never, I can't think of the last time we ever distributed less than 10% in a given year. So for us, the new rules being proposed or being thought about with respect to increasing disbursement quotas and things like that wouldn't make any difference. To be fair to other organizations, though, I do appreciate that, if you're running, let's say, an endowment for an organization and you want to sustain the ability to generate income, if you start paying out more than 3.5% to 4% to 5% a year, there's a good chance that you're going to start eventually eroding into your capital, especially after inflation. So I sort of do understand why organizations that want to be sure that they've got a sustainable capital base over time like the disbursement quota at 3.5% to 4.5%. But in our case, what our clients want to do is use PGF as a vehicle to make specific impacts on the organizations they want to support now. So therefore, we're always likely to be in a situation of having large amounts of disbursements each year. Okay.
Terrific. Well, we've had one comment here from Rob Lucy saying, disbursement, read Rob's book, How Will You Be Remembered? I'm not sure if you're familiar with that book or not, but maybe it relates to charitable giving.
I am familiar with Rob.
Okay, terrific. So John, that's the end of the questions that we have in the Q&A section. Is there anything else that you would like to say to our audience today in terms of what it's meant for you personally to share the pie and watch your organization grow and have other shareholders join you?
Oh, it's been one of those things where you can say initially, I'm sure there were at the beginning some people that said to me, well, I don't know if I'd do that if I were you. That seems like you're being overly generous. I suppose that this is not an apocryphal story. This actually occurred. But I guess the beginning of the concept of profit sharing occurred for one of my colleagues is Murray Nielsen, who many of the people listening in who know about, but Murray and I worked together at the Rogers Group for 10 years. And I remember at the time, second year that we were there, Murray and I had our own little team of 6 or 7 people. And we were handing out these checks. You could call them profit sharing checks. We didn't really have a bottom line or anything, but we just said, okay, we had a pretty good year. So here's a check. And let's say the average check was $2,000. And and back then, we're talking 1986, 5, 6, something like that. That would have been, let's say, 10, 12% of the average compensation for the people that were working with us at the time. And I remember Murray saying, oh, we're in trouble. The other guys, the other partners, I feel we're embarrassing them because basically we're giving out these huge checks. And I said, really? I didn't think they were that large. I thought that they were pretty reasonable. And then Murray's response to me, no. He says, they think it's just like way over the top. I said, well, what are they doing? Well, they're giving out Christmas hampers. I said, well, what do they cost? Oh, about $75 each. And I said, well, I think we should have a chat with those guys and just explain that we're not the problem here. The problem is in giving a $75 hamper to somebody that has been working so effectively for you for the last 12 months. It's a mindset. And so I've never found that making the decision to allocate to the people that are causing the results has ever caused me any regrets. So the fact that we fast forward 35 years from that point in time and look at it today and realize that it has worked out as well as it has, and there's so many people that have been able to do well inside the company and outside the company as well. So yeah, it's a great vindication for a theory that I believe it was important, and I'm glad it worked out as well as it did.
Terrific. All right. Well, thank you, John. So that's going to that'll conclude our webinar today. And we've learned today about, sharing the pie and how it can help build winning corporate culture, attract talent, and help business owners with succession planning. Thanks, John, for the valuable insight.
Thanks, Vanessa. Enjoyed that this morning.
And to everyone else for joining the webinar. I hope you'll also join us for the next webinar we're having on August 18th, which is a half-year update with Mark Canada, our Managing Director of Real Estate. So have a great day, and thank you for joining.
Thank you.